Can Circle build a moat like Visa and Mastercard? The battle for digital money dominance. Welcome to Blue Invest, the show where we explore the future of money, technology, and investing. Today we are diving into one of the most interesting stories in fintech. Circle Internet Group, the company behind USD Coin, or USDC, the world's second largest stablecoin. Circle went public on the New York Stock Exchange in June 2025, a huge milestone for the digital asset industry. But the real question is, can Circle ever build the kind of competitive moat that Visa and Mastercard enjoy? Or will it remain one strong player in a crowded and fast-changing landscape of digital money? Let's start with what Circle actually does. It's a global fintech company that provides the infrastructure for digital currencies and blockchain-based payments. Its core product, USDC, is designed to be fully backed by US dollars and short-term treasuries. $1 in the bank equals 1 USDC on the blockchain. That's the promise. Circle's mission is to connect traditional finance with the digital economy, and it's been doing that through a laser focus on regulatory compliance and transparency. They want to be the regulated face of crypto. But the competition is fierce. In the stablecoin and digital payments market, Circle faces rivals from every direction. The biggest one, of course, is Tether, which still dominates the market with roughly 60% share. Tether's advantage is deep liquidity and entrenched use across crypto exchanges, especially in emerging markets. Circle holds around 25%, a strong second place, but it's fighting uphill. Then there are the traditional banks. JP Morgan Chase has its JP Morgan Coin, Citigroup and a group of UK banks are working on their own tokenized deposits, and these will appeal to big corporate clients who already trust banks and operate under familiar regulatory frameworks. And it doesn't stop there. PayPal, Ripple, and even Robinhood are launching their own stablecoins, while DeFi projects like MakerDAO's DAI and Hyperliquid's USDH add even more competition. So, Circle is playing on a very crowded field. Now, let's look at Circle's strengths. First, regulation and transparency. It's one of the few crypto firms licensed in multiple major jurisdictions: the US, the EU, Singapore, and more. It publishes audits, discloses its reserves, and maintains a clean brand image built on trust. Second, institutional adoption. Because it's so compliance-oriented, USDC has become the preferred stablecoin for institutions and fintechs that care about accountability. That reputation gives it staying power. And finally, it has strong partnerships with Coinbase, Binance, and other large exchanges that distribute and support USDC globally. But there are vulnerabilities too. Circle's partnership with Coinbase comes with a hefty revenue sharing cost. Its profits are tied to interest income on those cash and treasury reserves, which means if interest rates fall, revenue drops quickly. And even though USDC is widely used, it still trails far behind Tether in liquidity and trading volume. Add to that the looming competition from banks and you start to see how fragile its position can be. So, could anyone else enter this market and challenge Circle? In theory, yes. In practice, it's extremely hard. The first big barrier is regulation. Launching a compliant stablecoin means dealing with anti-money laundering laws, KYC rules, and financial supervision requirements across multiple countries. That's expensive and time-consuming, a killer for small entrants. The second barrier is trust. When your product is money, reputation is everything. People will not swap real dollars for digital tokens from a random startup with no track record. Circle and Tether benefit enormously from years of credibility and massive networks of exchanges and wallets that already support them. And then there's capital. To maintain that 1:1 peg, you need billions of dollars in high-quality reserves. That's not something you can bootstrap. It takes deep funding and serious operational infrastructure. All this means Circle's existing position isn't easily replicated. It has a moat, but not an impenetrable one. Now, the big comparison. Can Circle ever become the next Visa or Mastercard? Visa and Mastercard built their moats through two-sided network effects. The more merchants accepted their cards, the more consumers wanted to use them. The more consumers used them, the more merchants had to accept them. That feedback loop has been running for half a century, creating a global payment empire that's almost impossible to replace. They also operate closed, proprietary networks. You can't just plug into Visa's system. You need to be part of their ecosystem, and that exclusivity adds power. Circle's moat, by contrast, is open. USDC lives on public blockchains like Ethereum and Solana, where anyone can issue competing tokens or even build systems that move money around Circle entirely. That openness drives innovation, but it limits control, and therefore limits profit potential. Visa and Mastercard earn massive margins on interchange fees every time you swipe a card. Circle makes its money mainly from interest on reserves, a business that fluctuates with macroeconomics. It's more of a financial product than a network fee business. So, will Circle ever enjoy the same kind of duopoly dominance as Visa and Mastercard? Unlikely. The underlying economics just aren't the same. Visa and Mastercard have closed networks with deep network effects and regulatory protection. Circle operates in an open environment with thin margins and constant new entrants. That doesn't mean Circle won't be huge. It just means it will probably coexist with others in a more fragmented digital payments world. Maybe the better analogy isn't Visa or Mastercard, but something like Swift or Plaid, critical infrastructure that connects financial systems behind the scenes. Circle could become the rails for digital dollars, powering cross-border transactions, stablecoin settlements, and programmable payments, even if you never see its logo at checkout. So here's the bottom line. Circle's moat is real, built on compliance, transparency, and trust, but it's not indestructible. It doesn't have the deep, self-reinforcing network effects that Visa and Mastercard enjoy. Instead, it's a leading player in an open, fast-evolving ecosystem where competition from banks, fintechs, and decentralized systems will always be fierce. The future of digital money may not have one or two dominant players. It might look more like an interconnected web of networks, some corporate, some decentralized, some government-issued, all interoperating. And Circle wants to be right at the center of that web. Whether it succeeds will depend on one thing. Can it maintain trust, compliance, and relevance as the rest of the financial world races to catch up? Only time, and the next wave of regulation, will tell. That's it for today's episode of Blue Invest. Thanks for listening, and if you found this analysis useful, don't forget to follow for more deep dives into the future of finance, technology, and investing.